Hey everyone, me Kevin here. In this video, I'm going to break down my thoughts and strategies for exactly what I'm doing in this market because this morning we had one heck of a crazy day. I woke up and the stock market was really red. Now, ordinarily, that would be really scary. People open up their portfolio and they feel a sinking feeling like they just made a big mistake, and then they look at the market and literally like almost everything was red this morning. The market open was really rough. Everything looked red. Everything looked like a disaster and bloody. And I want you to ask yourself, what do you think my reaction was this morning when I woke up and I saw the market really red? Well, if you said anything that would resemble this picture right here, you are correct. I was very happy this morning because I get opportunities to do my favorite thing, and that's buy the dip. Now, there are two ways you can buy this dip. And what I'm going to do is I'm going to give you a brief overview of this strategy because going into the weeds of exactly the technicals as to how this works are very complicated, and I just want to give a simple overview here because I've got a whole course dedicated to teaching you the weeds. And this isn't about teaching you the weeds, it's about giving you the overview of my strategy and my belief of the market. That's the point of this video. So if you want to know what I think is happening in the market and how I'm playing it, this is the video for you. If you want to understand exactly the details for how this works, if you have questions on this, you want to be a part of this with me in my private live streams or in the private stock group, then check out the link down below. It's 40% off. Use the coupon code. It does expire on July 22nd. Yeah, I extended the expiration of that, but the price will be going up and it will not get extended again. So on July 22nd, the pricing will go up. Okay, so check that out. Link down below. You get lifetime access. So if you said smiley face, that's the correct thing. What I like doing is I like buying the dip. Now, there are two ways that you can buy the dip, and this is very important because usually when we think of buy the dip, we just think of the number one way, buy shares. But there's actually another way that you can buy the dip, and the other way you can buy the dip is by doing something known as making a promise to buy shares. So I'm going to write down here, promise to buy shares. And both of these are ways you can buy the dip. Now, the cool thing about making a promise to buy shares, if you're telling somebody, hey, I promise to buy some shares at some point in the future at a certain price, the cool thing about that is you deserve to be compensated for making that promise. You deserve a credit for making that promise. And what I like to do is I like to say that SP stands for selling a promise or selling a put contract. Now, I know that got cut off a little bit there. There we go. Now, again, I'm not going to go into the exact weeds of selling put contracts about how the theta decay on selling puts is benefiting me and hedging my theta decay on my call options. If you want the weeds on that, I'm posting a new lecture on exactly all of the trades that I made this morning to break down, which you already know what my trades are if you're in my Stocks and Psychology Money group, but I'm going to be posting a lecture breaking down exactly the weeds of how this strategy works. And that'll be posted today. So right now, I want to give everybody watching on YouTube a broad overview of why I'm buying the dip with contracts. First things first, why would I not just buy shares? Well, I'm not buying shares right now because I personally believe things are pricey. Enphase at $181 is okay, but I think it's a little pricey. CCIV at $25 is okay. It's a little pricey. Now look, most of my CCIV shares I bought at $17 when the announcement of Lucid's CCIV SPAC was first announced. CCIV, there we go. I bought most of them around $17 to $17.80 in CCIV. I did buy a little bit at $30, but I thought that was a little bit expensive. Between $30 and $35, I did buy a little bit. I thought that was a little expensive. I actually think right now, based on all of what we've seen in the market and how difficult it is for Tesla to ramp their production, and they have the experience to do it, I actually think $25 is a little bit on the pricey side for CCIV. I also think SoFi has the potential of going down to $14.50 to $15, and then it's a good deal. So I think it's like $16.66 right now, but I think, like, for example, $17.50, I think it's a little pricey for right now, and I'm going to show you why I'm picking $17.50. I think, for example, Peloton or Lemonade or Apple or Amazon or whatever, I think the shares where they stand right now are a little bit pricey. And I don't like overpaying for things. I like getting good deals on things. So let me use an example here of SoFi quickly. So I wrote 1750 for SoFi, even though right now these shares are selling for about 1666. Why would I do that? Well, that's because I gave someone a promise that I would buy shares of SoFi in January 2023, when hopefully SoFi is a much more mature company, right? And 1750 is cheap. I am making somebody a promise to buy those shares in 2023 for $17.50. It's a little bit more than they're worth right now. And in making that promise, I'm actually going to get a fat credit. I'm going to get a credit of $7.45, or that's what I did get. So I don't know, it depends on when you look at the market. The cool thing about that is that actually means I'm willing to buy SoFi shares at $10.05 because I'm getting a big fat credit to do that. So by making this promise, I'm getting a big credit. Now there are a few ways this can go. If SoFi doubles and goes to, let's say, $35 in the future, okay, well, then what happened? What happened is I lost the opportunity to have my money go up to $35 and I kept $7.45. Okay, well, that's not bad. Got $7.45, but hey, could have had a double. I got maybe 40% instead of a double. That happens. There are obviously upsides and downsides to things. That's cool. SoFi is a really good opportunity to do this with, in my opinion, right now, because I really like the stock and I wouldn't mind owning it. But I'm going to take some nice credits for making those promises in this kind of market. And that's because I believe that SoFi is not really likely to double. In fact, I don't even know that SoFi is going to go to $25 anytime soon. I think it's possible that SoFi ends up trading sideways for a bit, kind of like a lot of SPACs have been. Sideways, moderately up, or moderately down. As long as it goes moderately up, moderately down, or stays sideways, I get to keep the $7.45. I keep the credit. It expires above $17.50. I keep the $7.45. That's great. Worst case scenario is the stock either doubles, which I don't think is going to happen, or the stock, let's say, goes down to $0. Because if the stock goes to $0, I'm still stuck paying $17.50 minus $7.45, so basically $10.05 for a stock that's worth $0. Then I get screwed, right? But if it's anywhere in between, things look decent. Things look pretty decent. Anywhere between $10.05 and somewhere around $24, $25. This sold put contract makes a lot of sense. In fact, take a look at what I just did. I took $437,000 of money and I signed this up as collateral, which does not cost me any margin, but it's from my margin. It's sort of reserve. It takes away my buying power. It takes up my collateral because if I have to buy these shares, then my margin starts getting used, but it's not right now, so I'm not paying any margin. And I made this deal. In response for getting or making this deal, I got $186,250 in cash. Folks, that works out to a 42% return on my money instantly if I just hold this contract through January 2023. That's awesome. And then I'll either buy the shares or I'll just keep the credit and I won't have to buy the shares. Either way, I get to keep the credit. So either buy the shares or I don't have to buy the shares at $17.50. But either way, I keep the credit. And in this kind of market right now, where I personally believe it's likely that even though the S&P has kind of done this, and tech kind of went like parabolic last year, right? And then lately it's kind of been doing a little bit of that, right? Even though that's kind of how the market feels like right now, and you could even put May in here, probably like right there, right? Even though that's kind of how the market feels right now, I think going forward, there's a good chance that we're going to continue to trade sideways, and I could make some good money by selling puts, by making these promises, and basically yield farming by taking credits. And that's what I've been doing in this market, because I think there's a good chance we could be in this sideways or slightly down, slightly up trading market for the next year. Now, it's possible that in between now and next year, we get some kind of euphoric rally, some kind of short-term bumps. Like, for example, Matterport right now is like $14.50 or something like that. A few days ago, it ran up to $17. So when it ran up to $17, I took advantage of that, and I sold my call options that I had, and I took profits. I took my tendies. So I'm not unwilling to take profits right now. That's very, very important. I'm not unwilling to take profits. I will take profits. If there's another euphoric rally, I'll do that as well. But in the meantime, I'm taking advantage of selling puts and gaining some credits to help offset the theta decay on my calls, and just because I don't think there are big buying opportunities yet. Now, if the market falls enough and we get enough of a drop to where all of a sudden Square is selling for $200, or Enphase is selling for under 150 again, or Etsy is selling for under 150 again, or Pins is selling for under 60 again, or Lemonade is selling, or Piton, oh my gosh, if Piton's under 80 again, or Lemonade 80 to 100, somewhere in there, or Lemonade's under 60 again. These are times I'll go heavy. I'll just buy the shares. But we're nowhere near those prices right now. So that's why I'm selling puts instead. I'm selling puts because we're nowhere near these prices, and if we trade sideways or moderately up from where we are here, I'm taking some sweet tendies, and I'll either get the shares in the future or I won't, but either way, I get that big fat credit. And I like that. For me, that is a better deal than trying to bet, because you do have an opportunity cost when you do options, than trying to bet that the stocks are going to go to the moon. Now, it's possible that they go to the moon, and that's why I still have a lot of call options. Like I have options on Pins, on Piton, on Apple, on Amazon, AMZN, right? I've got options on a lot of these. On Tesla, I have a lot of options on these. So I'm not getting rid of my very bullish positions here. I'm just waiting for that euphoric rally to hit where I can sell out of these contracts. And then probably after that euphoric rally, whenever that time comes, if it even comes, it just wouldn't surprise me to see the market trade a little sideways. So that's why I'm taking the strategy that I'm undertaking right now. Now, if you're confused as to how does put selling work, how do the mechanics of this work, what trades did you make this morning? Did you close your positions? Which I did. I closed a few positions this morning. I opened some positions this morning. I did quite a few things this morning. And hey, check out the Stocks and Psychology of Money group. Link down below. You get lifetime access, and that way you can also interact with me and you get the details. Right after I post this video, I'm going to be filming a detailed lecture on exactly my strategy for how to find these options, how to find my favorites, and how to see value in them, and why I do certain things. I'm going to be posting a detailed lecture on that after I post this video. So stay tuned for that later today. Thank you so very much for watching this video, and folks, we'll see you all in the next one. Bye.